My tip of the week is in retirement, your taxes change considerably, and we'll dive into what that means in our program today.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, founder of TJ Stearns, Inc., your resource, ladies and gentlemen, for a common sense approach to planning for your financial investment and retirement future. We always appreciate the time and the guidance, Tim. You always help us out by starting with the tip of the week.
My tip of the week is in retirement, your taxes change considerably, and we'll dive into what that means in our program today.
Absolutely, Tim. A lot of people get caught off guard by that change in retirement. It's not just your schedule and your alarm clock that change the day
Right.
after you retire, right?
Right, exactly. And I think a lot of people don't realize that now they are in charge of their taxes.
Yeah. During our working career, Tim, it's all kind of sort of taken care of. I mean, we still have
Yeah.
to file. The numbers still aren't exactly right down to the penny. They almost never are. But those taxes are deducted for us before we even ever see our money, and generally are about close to what we should owe, right?
Well, it's almost on autopilot.
Yeah.
Your company is taking the money out. You don't have to worry about it. Well, now you've got this big basket of cash that you've saved forever in your 401k or your IRAs and what have you. And now you're going to pull the money out. And guess what? You're in charge of doing the taxes on that.
Yeah.
And how much do you withhold and how much don't you withhold? Do you do a Roth conversion? What do you do with all that?
So taxes in retirement still exist. Retirement does not mean tax-free, right? In fact, they often become more complicated in retirement, multiple sources of income. You've got to figure out the withholdings yourself. And planning, Tim, for this creates some knowledge of the tax system, but it also can create the flexibility in retirement.
Well, yeah, I mean, you can actually, play with some of the tax brackets. You can actually maybe do some Roth conversions. We've talked about this time and time again that right now is some of the lowest tax brackets many of these people have seen since they started their careers, which is pretty neat. So you can actually do some Roth conversions. And, like Ed Slott always says, don't leave a 12% tax bracket unfilled. And what does he mean by that? Well, play up to that area or that 12% is. That's a great place to be. It's the lowest tax brackets you'll probably see in your lifetime.
Yeah, if you can get money out of a retirement account, of a tax deferred account, while only paying 12% in tax, it's a great opportunity, Tim. And of course, if our income is going to stay in higher brackets, we may want to consider those brackets as well. But certainly that 12%, one of our most advantageous brackets. So, Tim, multiple sources of income in retirement: Social Security, pensions, IRAs, 401ks. Roths. We've got to figure all that out on our own or utilize the help, the assistance, get the guidance of an experienced qualified professional to figure out what should we withhold from each of these sources.
Well, when you look at retirement income, it's a patchwork. It's not a paycheck. It's not straightforward like that. Each source that you just spoke of has its own tax treatment. So you really need to have coordination, and it really matters in that area.
And for example, just one of those sources, Social Security,
Oh,
sometimes
yes.
tax-free, sometimes taxed 50%, sometimes
Right.
85% of it is
Yep.
taxable. And we've got to understand those rules and those thresholds.
Well, yeah, and it's going to depend on what your IRA withdrawals are. If you have a pension, what that income is, capital gains, and then even tax-free municipal bond interest can trigger things.
And then tax deferred accounts always come with a tax bill. The IRS has not forgotten. They've just allowed you to delay paying the
Right.
taxes.
Right. So, I mean, the tax deferral is there, but it's not a tax elimination. It's a tax postponement, is what we say.
Yeah. And IRAs, of course, taxable when withdrawn, but Tim, also taxable when you do those conversions that you were talking about. And we can do rollovers. We can transfer accounts from one IRA to another, keeping the dollars kind of under the umbrella. But as soon as they leave that umbrella or pop that bubble, so to speak, like they are going to be taxable. And people sometimes forget about that. I call that the gross planning mistake. Planning for retirement on gross numbers, forgetting about the tax net effect on your withdrawals.
Right. I don't think a lot of people remember that, or they don't want to, they suppress it. And, to your point, whenever you take money out of your 401ks or your IRAs, at that point is when you're going to start to pay taxes.
Tim, a lot of people probably know what their balance is, but not a lot have calculated the tax bill that they will pay. How can somebody see that number or begin to quantify how much will I pay in taxes in retirement?
Well, it's funny you say that. We have a great report that we'll do for people for free, which if they go to www.mvpcfp, that's most valuable player, certified financial planner.com, that's mvpcfp.com, it will literally tell you what your tax bill will be over what your required minimum distributions will be, what the taxes will be for if you reinvest the money, and then, of course, what the legacy tax bill will be for your beneficiaries. Most people, I don't know anyone who does know that amount. I've never had anyone be able to quantify that. Well, we can, and I think that's really important.
And of course, Tim, if you do not enact a more proactive plan, then the IRS has one for you. And of course, we love our acronyms here. The IRS has a tax plan for your IRA, and it is RMDs, required minimum distributions.
That's right. And at age 73 now, for most of the people that are in retirement, that's when they're starting to take them. What we find is a lot of people take that money and they don't know what to do with it, and they'll put it right back into the stock market. And next thing you know, they're paying another tax bill. There are ways to do like a qualified charitable distribution where you don't have to pay taxes on that money and you can give it to your charity. We've had people do that to avoid the tax bill. Or you could put money into, we've had clients put money into a life insurance policy that has long-term care benefits. And then that money grows tax deferred and tax free if you pull out the cash in there. There's a lot of different elements to that to kind of suppress taxes down the road. And those are things that people should be uncovering, in their retirements.
So there are dollars that are more tax friendly or more
Yeah.
flexible than others. One of the big strategies that you've talked about, Tim, is Roth accounts. Specifically, Roth conversion strategies are a big part of retirement planning today.
That's right. And, like I said, these tax rates that you're seeing haven't been seen since 1982. So these are great times to be doing Roth conversions. Why do I like Roths? Well, there's no RMDs during your lifetime. It's a tax-free income flexibility area. It's a powerful legacy asset for your heirs. They'll never pay taxes on it. It provides, it helps manage brackets, when you're doing that. And then lastly, Medicare costs that, it's not going to bump you up into IRMA that you don't want to be part of. There's just a lot of things. But again, I would talk to a fiduciary, a certified financial planning practitioner like myself, if you're going to be doing things like that, because there are some pitfalls and you want to make sure that you know that.
And Tim, you always have, the disclaimer, wherever there's an advantage, there is always a disadvantage somewhere, right? That you've
Right.
got to know both sides of things. I think that's why I do appreciate your approach, is that you are very transparent about here are the tools available, here is the benefit of this one, here's the disadvantage of this one, and weighing all of them fairly and then judging which is most appropriate. But you did mention there that the Roth can help with Medicare costs and managing IRMA. IRMA on your Medicare premiums, that's kind of the hidden retirement tax.
Right. It's a stealth tax. A lot of people don't understand it. And they don't know about it. It's only about 8 to 10 years old. And what it does is it gives you a penalty if you make too much in retirement. So you're going to pay more for Part B and Part D because you have too much in income. And if you're married, you're going to get hit twice. There are ways to appeal it, but you most likely will be stuck with that price. And they do a 2-year look back, so you won't pay it forever, but that 1 year you might have to do that. And we've helped people appeal that, but it's an interesting process.
Yeah. Well, taxes, bottom line, Tim, can be higher in retirement than anticipated or expected.
Yep.
Retirees often pay more in taxes for multiple reasons that we've gone over today, but there are tax planning strategies that work.
There are different tax strategies that you can use, like Roth conversions in your lower income years, tax efficient withdrawal sequencing, managing your RMD exposure early, meaning taking them before you are 73 years old, or even in my area, age 75. Going back, we can use those qualified charitable distributions after you're age 70 and a half, harvesting gains and losses strategically. And then, of course, last one is coordinating Social Security timing with taxes.
But effective retirement planning also requires coordination and tax planning, Tim. I think that as this wave of baby boomers increasingly has become retired,
Yeah.
and we've sort of seen this generation move into retirement, I think that it's gone from investment management to comprehensive planning, including that tax element, and something you've been talking about for a long time.
Well, yeah, and coordination is key. We have a CPA on staff that helps our clients out, and we tell everyone who will listen to us that you should tap into a CPA or someone who knows how to coordinate all these things, because a lot of moving parts, and you don't want to really screw up a one-car parade with being taxed more. Who wants to do that?
Yep. Well, Tim, retirement taxes are different, but they are manageable. The earlier you plan, the better your results are going to be. And certainly having the assistance, the guidance of an experienced, qualified professional, a certified financial planning professional will provide you with measurable benefits, ladies and gentlemen. And once again, that website, mvpcfp.com, if you want to quantify your projected retirement tax bill, see what amount you might end up paying in taxes if you default to the IRS's plan versus how low you could get that bill if you do manage it efficiently and effectively. mvpcfp.com, mvpcfp.com. And of course, Tim, that is a report, but to put that report into action, to actually implement those strategies and therefore try to realize the savings, that is what you offer your complimentary Protect and Grow strategy session and put together that retirement blueprint for people.
The bottom line is, I don't know anyone out there who wants to pay more in taxes. So run the report and let's see if we can help each other get your tax bill down.
I've heard some billionaires mention that they should be paying more in taxes, but at the same time, they employ like floors of high-paid CPAs to figure out how not to. So it's kind of ironic to me there, Tim.
I would agree with you.
Yeah. Well, if you would like to join them in being more tax efficient, if you would like a plan to manage those taxes, ladies and gentlemen, give Tim Stern, CFP, a call. 800-640-2256. That is 800-640-2256. 800-640-2256. Tim, once again, always appreciate the guidance that you provide here on Protect and Grow Chicagoland Retirement.
Thanks for having me, Peter.
Tune into Chicagoland certified financial planner Tim Stern's full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.